Now, as we pivot towards the U.S., we want to look at what is happening with the money supply, what is happening with confidence, consumer movements. What are some of the indicators showing? And back to the point on the bullwhip that's going to create deflation. So the view is that you get a huge build, you had a huge drop in inventories, and now you're going to get a huge buildup in inventories because corporations panicked, they overordered, and they overordered into a consumer that is slowing. Now, the problem is the consumer's slowing, but just as anything else, the consumer is very fickle, and there's a lot of different levers they'll pull to try to maintain their underlying flows and their underlying assets. So you have to look at how are they trying to manage this. And as you get them slowing, you also have those supply disruptions, but you also have a lot of pressure in the emerging markets. And when you look at the inventories, you also, yes, people did order, but they didn't order as much as people think they did because they also didn't want to lock in these high prices. They were just going to try to buy what they could to get by in order to streamline some of their supply chain, but they also didn't want to lock in these high levels because then how do you recover these costs? So again, there's a lot of this back and forth, and the data now is showing the transition into stagflation, not deflation. Now, we do think deflation comes. That is absolutely the case. That will happen. We just don't think it is going to happen within 2022 or even the first part of 2023. That is more of an outside event that is going to happen, whether that be Q2 or Q3 of 23. As you get the consumer struggling. But when you look at where the consumer sits right now, where wages are, where inflation is, there's a lot of these back and forth. And as consumption slows, you should see that build up in inventories. But because there's these global shortfalls of different components of different things, whether that be raw materials or semi-finished goods, that's going to, again, provide some of that bump up. But also when you look at where housing prices are, where food prices are, we're not seeing a bumper crop. We're not seeing globally speaking, because there, as we said in segment 1, Brazil has one. But when you start to look at all of these pieces, there is a lot of tailwind. Now, there are headwinds, which is, again, why we see more of that stagnating component and less of that extreme deflation, because the view for some of the more extreme bullwhip individuals that have been talking about this is that snapback is going to create a very stiff and stark contrast where you've had this explosion of inflation up and you're going to get a huge deflation down. We don't see that deflationary pressure really starting to emerge until we get into next year. Now, when you start looking at some different money supply, I think it's important to look at the money supply data released this week. Showed another monthly decline in both nominal and real terms. Nominal rate at 6.5%, back to the average since 2013, and in real terms, it's negative. And it's important because you need to start taking some of this money out of the system. And that again is going to be the component of reducing the balance sheet, the Fed balance sheet, the Federal Reserve balance sheet, for those that don't know what I was referring to, as well as, again, trying to bring some of that liquidity back under control, because we still have over $2.1 trillion in the RRP. There's clearly too much liquidity that remains in the system, even though we're getting the financial conditions tightening. You still need to see a lot of this come out because it also builds on itself when you're looking at M2. So when you look at how M2 has been so consistently over that 100%, 0%, when you look, even the real money supply has been continuously growing. You need to see this stay negative for an extended period of time to really start to drain a lot of this excess out of the system in a meaningful way. And I'm not saying we have to go to 10% and stay there, negative 10% and stay there, but something that is going to be more of a reduction And if you think about the Fed's idea of getting the balance sheet back to 18% of real GDP, when it currently sits at 37%, you get an idea of why we're going to be at these levels at this point in time. But when you start looking at the demand front, the economic sentiment index, you can see it's moving in the wrong direction. And the important pieces on personal finances and new job are starting to pivot down. And that is driving the way people see the U.S. economy. They see that slowdown increasing. So that's causing them to lock down a bit more and be a bit more cautious on their spending, because they do think that some of their finances will come under pressure. And then when you start looking at, well, how is this going to impact the bond market? And this is how you're seeing more bonds being pulled or canceled. And it's the highest since February because, again, rates have gone up. No one wants to lock in rates at these levels. They would rather lock in rates much lower, obviously, because it increases interest expense. But there's going to be a point where you have to roll your debt. But when you look at zombie corporations that not only have to roll debt, but also have to issue new debt just to stay alive, this gives you an idea that the panic is starting to increase. And as that panic increases, that's going to increase the stress, which again is going to pull down some of these companies, and hopefully we'll start to see some controlled bankruptcies as the people go into some restructuring. The weak companies getting liquidated, the strong companies getting new or different financing terms, and showing that they can hit a cash flow number. Because right now, cash flow was meaningless. It was just, well, we're a growth story, so we don't need cash flow. Well, as that changes, that's where we're going to see this get pushed through. Now, back to those points on financial conditions around federal fund rates increasing, and you can see it based on different recession and rate hike cycles. You can see that this is the fastest increase in financial conditions, looking at some of these others, which is also, again, leading to those bonds getting pulled because they're waiting and saying, well, maybe things will cool off a bit. And then if they cool off, we'll reissue some of these bonds in order to, or go back to market to try to get some of this into the capital into the system. So now when you start looking at the GDP, so the final revision for GDP was quite ugly, and it wasn't so much on the underlying piece of 1.8%. But when you look at it went from 3.1% to 1.8%. But the GDP moved lower from 1.5% to negative 1.6%. But it's the personal consumption. The personal consumption, which we had said when they released it, for those that remember back when we talked about it in the beginning of Q2, 3.1% personal consumption made no sense, because all of the data was pointing to something way lower than what was actually being described. And now there was a big true-up number where personal consumption went from 3.1% to 1.8%. Now, 1.8% is what we can get behind. That's what we were seeing, something much closer to that number in terms of growth versus what was being discussed. Because we were looking at this saying, like, guys, like, we, based on all of the leading indicators we've seen, all the present indicators we're seeing, that were future claim on this personal consumption. And the problem is, consumption has now gone negative in Q2, which we think, again, drives things even lower in Q3. But it's not a steep drop off. And that's the problem when you're starting to look at the consumer. You don't get this demand destruction in the U.S. isn't this precipitous drop. And it's just things flatline. They eke down and then they flatline and they just don't bounce. They just kind of stays in this tight level, and we bump along the bottom. Now, there's always going to be that washout period, but we don't see that yet. Right now, we're seeing this contraction, slightly negative in some spots, some leading indicators going deeper negative, which we're going to talk about in the next segment, which is going to put some of that additional pressure. So when you start looking at the different pieces, the drags were trade, which was obviously down 3.2%. And inventories, because you had a huge build in inventories in Q4, you had a smaller drop in Q1, and now you're seeing inventories kind of bump along and go sideways, where you've seen some of the slowdown on orders, new export orders, new orders in general have come down. So as those come down, that again is showing where inventory is headed. Whereas people aren't ordering anything new because they're sitting there saying, well, I have a lot of inventory, or if I don't have a ton of inventory, I see demand weakening, so I'm not going to rush out and go buy something, which again is going to keep some of this, fairly firm. But the consumer spending, with the spending on services only growing 3% versus the estimate of 4.8%. So the consumer spending, again, seeing that shift down, and the rewrite, a lot of that was on the services front, which again leads to more of the problems that we're seeing into the back half of this year. And the tighter financial conditions, it's also going to slow down that manufacturing, because if you have financial conditions coming under more and more pressure, it's just going to lead to a cut in CapEx, because if your spending plans were X, but Y of that was going to be covered by bonds, well, if you're pulling your bond, then you're going to cut the CapEx because you're going to try to tighten your belt and protect and reduce some of your spending. Now, when we look at the nominal account balance, the U.S. current account deficit widened in Q1 to $291.4 billion versus the estimate of $275 billion in the prior quarter. So the goods deficit widened to $342.2 billion, while services surplus narrowed 58.5. Again, just showing what we already knew in terms of some of that steep drop as imports really picked up as we went into Q1. So the mounting losses. So again, looking back to bonds getting pulled, companies starting to struggle. So the number of money-losing companies has snowballed in recent years. And again, if you're losing money, that means you have to borrow to maintain your status quo, or you have to cut your status quo. So a record number, 128 members of the Russell 3000, worth $281 billion, have failed to turn a profit in any quarter for 6 straight years, and almost tripled since 2017. But as the era of easy money and lofty valuations that brought them to market in the first place come to an end, you're going to see that move down. And that's when hopefully we start to see the market balance out. But just think about that, 6 straight years, $281 billion worth of companies. So 128 members turned a profit and not in any quarter for 6 years. There's a certain point where, okay, you have to show growth. Like from my perspective, like if you're not turning a profit by the end of year 1, or realistically the end of year 2, there is a big issue with your business plan, with your adoption, with your market penetration, and you really have to adapt to what is happening. So when you start to look at capitulation, it has been in bonds, not stocks, because people are looking at this and their fear is there because you own this debt at such a low interest rate that if you start to get some of these pressure points, and especially on the inflation side, you are losing money because you're not earning back, because what you're losing the difference in inflation, which again is creating some of these problems. Now, when you start looking at the future, this is, I think, a really important chart. When you look at inflation-adjusted real total card spending by income group, seasonally adjusted, you can see that everybody is now negative. So according to Bank of America internal data, obviously using their credit card data, spending has slipped into negative territory for all 3 income groups in May. And again, as you start looking at the data that we're going to talk about on retail sales, real spending versus nominal spending, this holds true. And we see this accelerating, especially at the lowest front. Now, when you start to look at the different shifts in ownership, the richest 1% of Americans held almost half of all corporate equities and mutual funds fund shares in Q1 of 2022. Among the bottom 1/5 of households, about half of their wealth is held in real estate. So when you see real estate coming back under pressure, and now you see equities and mutual funds coming under pressure, that again you're gonna see that pressure on both sides of that curve. But again, one can handle it much better than the other. And how much did the bottom 40% borrow against their homes based on equity lines and other? That's also going to create some of that struggle that we're going to have at the back half. And as the labor pessimism emerges, and that's when your expectation of losing your job, you can see that the upper income expect a higher unemployment within their own personal as well as their expectations. And if you think about it from their perspective, they're high earners, so they're again expensive to maintain, but they're also going to be the ones that are going to fire those that are in their division or in their team. So if they know that their team is going to go from 20 people to 13 or 15. So they're also speaking because they know what's to come. They also see what's happening at their level in terms of their friends that might be vice presidents or presidents or senior VPs, and where that pressure is going to continue, which is why the Gallup Economic Confidence Index has fallen. So the Economic Confidence Index has plunged to negative 58, the lowest since February of 2009. As of June, 85% of Americans said the economy is getting worse. And again, they're seeing things firsthand, which is why we expect to see some of these slowdowns. But you might think, well, why is that not going to drive deflation if this is happening? But then you start looking at, well, loans and leases and bank credit. So all commercial banks have started to increase some of their loans and leases. And loans and leases and bank credit and all commercial versus total assets. So they're starting to reinvest some of their savings. So when you saw this drop, you saw people hoarding their banks hoarding. So essentially, for every dollar they held, they were lending 47 cents. Now, for every dollar they're holding, they're lending 50 cents. It's still low. I am not saying it is high because clearly it's still at a very depressed level, but you're getting an idea that they're starting to open back up, but it's going to be driven by interest rates because as interest rates go up, they'll be more advantageous to lend and to try to get this money into circulation, which is more of a normal market, but we're still far and away, not close to that, but again, getting there. But then when you start looking at, well, how is this impacting the individual? And so when you look at the purchase only house price index and versus hourly earnings, you can see the huge shift continues to go up. Now, it doesn't just drop. It's more of a curve and then a roll. And we believe that we're in the process of forming that top and coming down. But because CPI and inflation is lagging so far behind home prices and rent, that's going to, again, keep that stagflation. And when you start talking about some of the key pieces on that sticky inflation front, this is what we're seeing. Now, when you start looking at wage growth tracker, you can see that on a total basis, as people are essentially their cost or wages have gone up, this is nominal, not real. Whereas the nominal cost has gone up, corporations have increased their robot orders because they're like, well, if it's costing me a ton to hire someone, I can spend a little bit more, get a robot, and then my cost over the longer term will come down. So again, you're starting to see some of that automation replacing some of these key people. But then when you look at the real employment cost index, total compensation for all civilian workers, in March of 2022, it's 3.9% below the pre-pandemic trend, which is, again, showing you that even though the nominal side has come up, which has pushed corporations to reduce their hiring to pick up more robots, on a real basis, the wages aren't even maintaining current living standards. So that's the conundrum that we're seeing, which will lead to that deflationary cycle because people essentially can't afford current pricing levels. But again, that takes time to play out, which is why we don't see it in this year. It's more of a second half of next year event. And all the while, with all this pressure coming through, you can see that retail investors continue to be buyers of the dip. And again, that's also going to lead to more pressure because these are the people that are averaging down. And a lot of the times they're doing it on credit or leverage. They're not doing it with actual cash, which will lead to a bigger problem. Now, when we start looking at all of the key pieces together, the U.S. manufacturing business sentiment, when you look at all of the regional data, when it is at a negative, on average, negative 8.4. So New York was negative 1.2, Philly was negative 3.3, Richmond was negative 19, Kansas City was negative 1, Dallas was negative 17.7. So all of the manufacturing business sentiment is now firmly negative and showing more pressure, which again is going to lead to what we've been talking about as pressure coming into the end of Q2, because this is showing you June data. So the trend is negative, and we believe that gets even worse as we progress forward. Now, another key piece to, even as manufacturing slows down, which again is going to slow down orders, is going to slow down some of the inventory build, the PPI goods prices across the supply chain, unprocessed pricing is still at a record level and rising. So that's unprocessed. Those are things sitting in the warehouse that are at higher prices. So the company is going to try to pass that through as much as they can, which again is going to provide some of that backstop. Now, the consumer can say, absolutely not. I will not pay that price. And then the corporation or the company is going to have to essentially eat that difference. Now, right now you have that battle of who's going to eat the cost increase, and so far the consumer has been doing so. But when you start looking at the Conference Board consumer expectations versus current conditions, this is typically the area that we are in when a recession sets into place. And now the pressure is also mounting. If you remember, the RRP just came out at 2.33 trillion. So we said over 2.1. We're still at 2.33. Now, the likelihood of having to leave in the next 2 months. So the likelihood of eviction of less than 25,000, you're seeing it obviously increase. About 3.5 million households say they are very or somewhat likely to leave their house in the next 2 months because of eviction. In Atlanta and New York, there's already evidence of the renting squeeze. About 15% of U.S. renters are caught up with their payments, aren't caught up with their payments, according to the census data. And it's about to get worse this summer as many leases come due and landlords boost prices. This overall represents 8.4 million Americans who are struggling to pay their monthly rents during June 1st to June 13th during the census period. So again, this is just more pressure in terms of as we come back into this normal market. And it's unfortunate because nobody ever wants to see someone kicked out of their home. But as we start to see this balancing act, as these apartments come on the market, this actually brings down the rental price, because then all of a sudden you're going to have more supply. And as that happens, you'll start to see a little bit of a balance out over the longer term. Now, on the other side, so that's the housing side, but SPACs. So SPACs, they are approaching $183 billion of value of deadlines. So essentially, if people give you money into a SPAC or into a trust that the SPAC has access to, you have to go out and buy a business. Like, I gave you money because you said you were going to buy a business. Well, if you don't buy that business, you have to give me my money back. And this is where we start to see some of this pressure. So as sponsors either need to find a target with which to merge or must return capital. This could also lead to there's two things this can lead to. One, you get your money back. It'll be at less than fees and everything else, but you'll get some of your money back. It won't be all of it. Or these SPACs and these management teams will panic and just buy anything at any price and essentially permanently degrade a person's value, because they just ran out and bought a company without consideration of, is it going to succeed? Is it going to grow? Is this the right thing to do? Because they just want to deploy capital, as quickly as possible to make sure that they can collect their own fees and not working in the best interest of the shareholder. So now when you start looking at all of this and take real personal consumption expenditures, the consumer spent 0.2% in May, but in real terms, it was 0.4%, negative 0.4%. Disposable income was 0.5. Inflation adjusted, again, negative 0.1, more negative growth. Savings at 5.4% of discretionary income, lowest since 2009. PCE inflation, 6.3%, which was flat. Prices at, core inflation, positive 4.7%. So again, you're seeing this stickiness where you're seeing that sideways move, but you haven't seen the spending on a nominal basis come fully negative yet. And until you see nominal and real terms really starting to show that pressure, it's going to be difficult to say that we're going to be in a deflationary backdrop given where inventories are and given where the pieces are in real terms. So then when you start looking at the important pieces, you're seeing it cap out, but again, you're not seeing this big drop off, and you're still seeing, again, a headline PCE at 6.3% is near its 40-year high. Core PCE inflation, it cooled by 0.2 points, but it's still near 1982 highs. So you're still at these elevated levels, and because of that push and pull between headwinds and tailwinds, that's where we get this kind of fixed at this flattening level. Now, personal income came in at 0.5% versus estimates, but spending, again, coming at 0.2 versus the estimate of 0.4, and then obviously the negative 0.4. But when you get those revisions, the revised down in spending in April, it was revised down from 0.9 to 0.6. So it makes the real terms even worse. And you can see the trend is moving in the wrong direction when we're considering GDP growth, which is why we think this shows up more in Q3 versus Q2, because again, Q2, you still had some of this growth. Now, personal consumption, for past year and a half, inflation-adjusted durable goods spending has made no progress and is in fact off peak by 11.6%. And we think the goods side continues to trend lower. And then when you start looking at the consumer confidence business better in 6 months, you're seeing that the expectations is the lowest it's been in essentially since 2016. So consumer expectations for better business conditions over the next 6 months have fallen to the worst since March of 2016. Labor sentiment weakening, jobs plentiful component of the consumer confidence index has ticked down to 51.3 off the peak of 56.7. Still fairly strong. Again, like you just have to look back in history. You're still at the highs. So again, wage pressure is going to remain. Rent pressure is going to remain. These are things that you need to see a steep drop off to really start to get a deflationary cycle kicking up. And we're just not getting that right now, which again is keeping things more on a stagflation backdrop versus deflation. Now, retail inventories expanded by 1.1% in May, less than 1.6% estimate. Stronger than the prior month, but inventories have grown for the past 8 months, longest streak since the end of 2020 into early 2021. So again, you're seeing that, but the pace is slowing, and that's because companies are ordering less. And as they start to balance that out, that's why you're not going to get this massive bullwhip. You've seen it. You see it in 2020. You see some of the spikes at the end of 2021. But now you're starting to get some of this balancing act, which is why we're going to see some of these competing pieces and not this huge degradation. Retail sales continue to fall relative to inventory in absolute terms. Ratio is still high, but the trend has turned decisively weaker in favor of inventory growth. So you're moving down as retail sales slow, but again, you're just look at the rate of change, and we see this leveling off a bit as inventory and that build starts to slow. And the reason why is because, factories are slowing down. So the message from U.S. factories is pretty clear. Demand is slowing down, new orders, helping delivery times normalize and taking pressure off of some of the prices. The economy continues to expand, but that does not strike us as an environment. When you look at the environment in terms of where some of this inflation is going, because they still have high cost. And that's what they're trying to recoup, which we're going to talk about in the next segment as well. So they're looking at the different pieces. Consumer confidence was expected at 100, came in at 98.7. Consumer expectations came in well below at 66.4. And then when you start looking at some of the drivers of it, consumers are becoming concerned about job prospects going forward. The future employment component is now a drag on the overall confidence. And if you're concerned about your job, you're going to tighten your belt even further. which we are seeing in terms of mobility. Grocery store, pharmacy activity, mobility has returned to pre-pandemic levels, but same cannot yet be said for retail, recreation, transit stations, and workplace. So grocery stores, pharmacy, things that you need, you have to go to, but the things that you don't need well, you do need a job, but again, with the flexible schedule there, you don't need to go in every day. That's where you're seeing some of these backdrops, which is leading to, and again, why we're seeing some of this inflationary pressure, prices and profits and power. So when you start looking at cost of goods sold has gone up, but total sales, they're still able to pass through some of this price. Net profit margin versus operating margin have also been able to go up as they've been able to push up these prices, and how long that will remain is going to kind of depend on how long some of this inflationary pressure will be passed through. University of Michigan consumer expectations obviously is firmly negative into 47.5. And then U.S. consumer sentiment versus unemployment have a huge decoupling, which is why we do expect to see the unemployment rate come back down. But because there are less people of working age, or at least the participation rate is so low, that again is propping up some of those unemployment numbers, which we do think will start to normalize. Consumer, the confidence side, consumer confidence index, as you can see, continues to move lower. And then as we look at what does this mean for expectations, consumer confidence minus present situation, this is again leading us to believe that there is a recession on the horizon. Within June, consumer confidence index present situation fell to 147.1, while expectations sank to 66.4. The spread between them has fallen to negative 80.7. Many prior recessions have occurred when the spread was less negative than it is now, again, giving some of that confidence that we will see this pressure going forward.